The market really only has 3 directions, up, down, and sideways, but knowing when and how to enter the market at the right time and place and price is a lot harder than it looks. That's why trading without a well-oiled plan leads to losses a lot more than half the time. We don't actually know when, where, and how the big institutions who have orders big enough to move the market are doing their business. Fortunately, we can make some solid educated guesses using support, resistance, and trend lines, and combine them with some logical entry methods to turn the probabilities in our favor. Some of the challenge, a lot of the challenge is psychological, because when we have actual risk on in the market, a lot of sensibilities can just quickly go out the window. There's just something about being in an actual trade that cranks up the second guessing, doubt, and just general jitteriness of even the most well-studied day traders. And what happens is it's really tapping into our past traumas and our insecurities and even our unhealthy notions about creating wealth. And that's where having a solid set of rules and guidelines comes into play. And that's what makes the difference between the trading success stories and the failures. If you can learn to identify and trade breakout opportunities, you should be able to find multiple opportunities most every day and make a lot more sense of the market, which makes for more relaxed and more profitable trading. So let's talk about breakout trading, what to look for, and how to trade them. Before we dive in, let's talk about the ugly. Breakouts have a notoriously low win rate. Breakouts fail around 50 to 60% of the time, but the trade-off is a potentially high reward, because breakout trades can cause a big reaction, like a short squeeze where stop losses are triggered into market orders and short sellers are forced to cover and buy back their positions for a loss. Or on the other side, panic selling triggers capitulation in a breakdown. The good news is that understanding how breakouts work, along with some simple rules for trading them, can help us increase our odds significantly. Add good trade management, and you can make a living just trading breakouts. First, we need to identify a strong level of support and resistance in either a price level or a trend line. The higher the time frame, the stronger the level or line, and the stronger the potential breakout could be. I start finding levels on the weekly chart and work my way down through the daily to the hourly, but not really below that. I don't day trade off of these higher time frame charts, but it's a lot easier to do a solid analysis and identify general trend and mark up your charts when you're zoomed out. Then you can zoom in and watch the intraday price action interact with those levels. If you're newer to trading, finding these levels may seem hard because there's a lot of levels being thrown around by other traders, but the most important levels and the ones that will teach you to see the market in a profitable way are fairly obvious. These are the best areas of the market because they're the most obvious, so everyone uses them. It's really that simple. You can complicate things later if you want to with all kinds of crazy stuff, but you don't need to. To find support and resistance levels, we're looking for areas where there are a lot of swing highs or lows. When we find these levels, there will often even be an opposing level or trend line where price is consolidating into some chop. Take a look at how these levels often break with a strong move. That's the move that we want to capitalize on. When marking support and resistance, price levels where there's a shift in the pattern or structure are the most important key levels. For trend lines, we want at least 2 touches. In fact, the more the merrier. And I've seen some confusion over using the wicks or the candle bodies. Personally, I use the wicks because they show the true swing highs and lows, which show where real orders were completed. And the candle bodies are going to vary depending on the time frame. But whichever you use, just make sure that you're consistent. All these touches really show is where the big players' orders are resting. And the more tests of a line, whether it's horizontal or diagonal, the more a wall of resting orders has been chewed away at, and the weaker it is as more and more traders are taking profits and otherwise bailing from a position. The more times price has reached the level, the more these large orders have been filled and are out of the market. A breakout happens when the buyers bid up the price and the market runs out of sellers at an asking price. Buyers will have to increase their bids to get orders filled with sellers asking more and more as demand exceeds supply, now that that large player is out of the way. The more you watch charts and look for these levels, the more natural it becomes, I promise. It makes sense that the more tests a line has had, the more likely it is to break, but that's not the only clue that you could look for. I could go on and on about support and resistance since it's the foundation of every trade idea I have, and I do have other videos if you're interested. But the key to finding key levels is that they should be obvious and where a change occurs. The stronger the move at the change, the more important the level, and the older and more tested a level is, the weaker and less precise it can be. There are a few things to consider before looking for an entry strategy, such as timing, literally the time of day. This is especially for day traders, but the same times work really great for swing traders as well. The first 2 hours of the New York morning session have the most volume, and with it, the most movement and volatility. And it's a handy time for, all of the finance bros and broettes to make any portfolio adjustments after any overnight news or changes. And as a bonus, the European markets are still open, so they're overlapping for some additional volume, which makes trading easier. We also need to keep an eye on the financial calendar for major financial news, events, and data. The market can consolidate waiting for these events, and a resulting breakout can be more news-driven than technical. But these breakout levels can be used for an entry strategy. Entering before a data release is really risky. You can potentially capture a big move, but you can also have a stop out with some really ugly slippage because we never really know what the market's reaction will be, even if we have an indication of how the data or news drop will go. The continuations after these news events can be just as powerful, sometimes even more so, and the breakouts can be more predictable and therefore less risky to trade. They can also have a lot of reversals, so waiting for confirmations can help keep us out of a lot of trouble. A breakout is a break in structure. We've identified structure with our levels and trend lines. Now, when we get a change or a break in that structure, we can look for a potential trade. This is when patience, or patience, as we traders like to say, really comes into play. There's a delicate balance between patience and avoiding FOMO. One of the main reasons is bull and bear traps, so let's talk about it. If you spent any time day trading, you're probably well acquainted with the concept of bull and bear traps, where price breaks a level before quickly reversing and trapping all of those breakout traders. A false breakout is always the danger to a breakout trade, and why a stop loss is really important. But the stop losses can be nasty if you don't know where to put them. When a stop loss hits at a level, it doesn't necessarily fill at that level. In fact, you're likely to get an ugly surprise when the order converts to a market order and fills with the nearest matching buyer or seller, which is probably not at that exact price. If we try to jump into a trade without a systematic entry point to avoid missing the move, we're more likely to fall victim to a trap. Obviously, we need a way to cut down on those losses in order to make trading breakouts profitable. For that, we can look to some clues in breakout trading to avoid these traps where stop losses can be used as liquidity for a reversal, and we can take a systematic approach to managing our entries, targets, and exits. We need to avoid taking the market's bait so we can have an entry that isn't left out to get slaughtered. That's where different entry methods and confirmations come into play. Before we even consider an entry, we need to figure out the risk to reward. So what kind of move are we looking for? Before you enter a trade, you need to know where your entry and exits are. What are you looking to get out of the trade? To trade a breakout, we're looking for a big move. Otherwise, it was a trap. We need to be looking for some distance or meat on the bone. There are a lot of targets that we can look for because in addition to those major levels of support and resistance from higher time frame levels and trend lines, recent swing highs and lows, support and resistance levels, VWAPs, and Fibonacci's can make for some great targets, as well as pivots or quant levels that are based on a combination of different ranges and statistics. These quant levels take a lot of different factors into consideration, which is why they're getting so popular. If there's an additional idea behind the trade, like the seasonality of an energy trade or a positive outlook for a particular industry, it can be even more of a moonshoot, which is the holy grail when we're using something highly leveraged like options. What speaks to you in a way that helps you enter and exit the market effectively and profitably is your edge. You can't and shouldn't use them all, or you'll be a busy idiot always looking for an entry but never finding one. Personally, in addition to support and resistance analysis, all I need are VWAP, maybe a moving average, and some intraday quants or pivots. When you're still developing your own edge, there are plenty of other traders who offer levels and systems to newer traders, and they basically fall into two categories. The first is the successful trader who enjoys the sense of community as well as the personal growth that they can get from working with other newer traders. And the second is the opportunist looking to capitalize on the would-be trader with a bunch of flashy promises, hiding the fact that they need to do this in order to make up for their lack of trading skills. Keep in mind, we aren't looking to call the high or the low. Our goal isn't to get the entire move. Our goal is to get the most reliable portion of the move. It's really fun to share all these things online, especially if you have no other wins to celebrate, like profits. But if you're trading for profit, you're looking to trade with a statistical edge, and a statistical edge will give you the most likely time and place to enter the market. Not necessarily the high or low. It could be, but it's usually not. To actually apply all of this into actual trades, first I'm looking at context. This is where the narrative from the higher time frame charting comes into play. We know that at strong support or resistance, there's likely to be a strong reaction, and we can easily get a sense of trend, which is really simply just a series of higher highs and higher lows, or lower lows and lower highs, or it could even be a lack of trend. And these higher time frames see important breakout points that are likely to be strong key levels again, because these bigger levels are where the bigger traders are. Whether we're day or swing trading a breakout, it's hard to time exactly when to enter, which is why picking the right instrument is important. So a short-dated option depends a lot more on timing than a futures contract or a longer-dated option. And equity could also tie up a lot of funds, so you have to consider that. There are a lot of different ways to skin a cat or capture a trade idea. So the best product to trade is also somewhat trader-specific. There's a lot to consider here, but for me personally, I tend to use futures to day trade indexes and weekly or monthly options to swing trade their ETFs or any underlying stock that has caught my eye. Okay, so Then we're watching a breakout level or a line as price reaches it. This is where FOMO kicks in and we get really afraid of price taking off without us or losing out on the main part of the move. This is where our trading psychology skills need to be implemented. I talk about thinking of your trading funds as just trading funds and not money, because it's not money in the sense that you don't need them to pay any bills. They're funds set aside and dedicated to trading responsibly. It's not responsible to use FOMO as an entry, so we don't. Breaking a level isn't an entry, it's our signal to look for an entry. If we enter at the potential breakout point, we risk the breakout failing. If it's an already tested level, we know that so far, attempts to break have ultimately failed. The big players don't generally leave their massive orders on the books. Instead, they have batches of orders that they will place and pull in these price ranges as needed, usually using some software to kind of automate the whole process in an attempt to be, less obvious and avoid unfavorably affecting price by exceeding the market's demand with their supply of orders. It can cause some confusion around the breakout point, and we can take a lot of risk off of the trade by waiting for the breakout to be confirmed. Without confirmation, it's really easy for our stop to get chopped up unless we place it fully outside of the recent consolidation or the next support or resistance level, which can be kind of far away. This is why we can't enter the market between levels or when we're extended from a trend line all willy-nilly and expect to make money. Not only do we need to watch out for the level being rejected again, we have to worry about a false breakout, the dang bull and bear traps, where the level is broken briefly before reversing. If I tell you the most important skills in trading are patience and discipline, in this case, it's the patience to wait for a proper entry and the discipline to follow the rules when you get one. We aren't missing out on the move. We're confirming that the move is real because statistically, it's better to miss out on the foreplay of a move to catch the main event rather than risk putting in all the foreplay just to get blue-balled by an unconfirmed failure. The most simple confirmation is a candle close beyond a breakout point. But Barbie, which time frame? Well, as usual, the higher the time frame, the better. That's pretty vague, especially for day trading. And it can also lead to FOMO City. So let me cut the crap for you. A super low time frame like a 1 or 2 minute has a lot of noise. What that means is it'll keep you bouncing in and out of a lot of trades more often, which means not holding very long, stopping out more, and wasting more on commissions. I'm sure there are exceptions to this rule, but that's true of most traders. My personal favorite, at least these days, is the 5 minute, but I will poke around some of the other lower time frames to see if something is developing that's worth taking a closer look at. That said, the type of candle can be even more important than its close. So what's a good candle close? A candle that breaks a line with some enthusiasm, with a strong break, meaning the full body through the line, not just a wick, is more likely to be a real break than a false break, because a strong, impulsive move like that shows excitement. If price is coming up and back down again and forming a lot of wicks and small candles, this isn't showing conviction in the market participants that price is ready to move beyond a line. Weak sauce, just another test. To put things super simply, a breakout is an exciting big move, and a retest has more timid little candles that just put their little toes in the water. And when you see these big candles, you may think you've missed out, but the experienced trader sees time to pay attention. Have we entered yet? No. Getting confirmation from a candle close is good. Getting confirmation from a candle close and a moving average is great, because now we're getting some trend behind us. I'm also a big VWAP fan. If VWAP works better for you than a moving average, by all means, use what works for you and what you trade. Getting a candle close is good. Getting a moving average confirmation is great. Waiting for a retest is best. Let's translate those thoughts into entries. Keep in mind, for an entry, we also need a target and a stop, and they all three go together to form a trade. A really simple way to find an entry at a potential breakout level is to mark the nearest swing high and low. We can get into nuances about which time frame to use, but the high and low should be obvious. If we're day trading, it's going to be on a lower time frame chart, and if I go down into the extremely low time frames, I'll have to deal with a lot more noise and nonsense. Depending on the speed of the market, that's usually the 5-minute for me, but it could also be the 3-minute or the 15-minute. You may find your sweet spot elsewhere, and that's okay. That's our candle confirmation. If price breaks the swing high above a resistance level or a swing low below a support level, that's a good indication or confirmation of a break of that level or structure and a good entry point. We can even make it easy on ourselves by putting a buy stop or a sell stop a few ticks past that swing high or low, and with some software, automatically enter a bracket trade. When you're new, you don't have to worry about any of that yet, but I wanted you to know about the possibilities. We'll get into the targets and stop losses in just a bit, because a candle confirmation alone won't give many of us the confidence to put our funds at risk in the market. Another really simple indication of trend is our moving average, which is where we can improve the probabilities of success for our trade by confirming that we're trading with trends, with price being on the correct side of the moving average. Different traders with different time frames tend to settle into their different favorite moving averages over time. Personally, I'm a big fan of using the VWAP or volume weighted moving average anchored to the session that I'm trading. I also like to day trade with the 50 SMA, and if I need something tighter, the 20 or 21. The reason that there isn't a set in stone answer to which moving average is best comes down to how different personalities see the market and take risk, and which asset you're trading. It'll vary a bit by your time frame, but in general, it should follow price as it makes a higher high, higher low, or lower high, lower low pattern. It's too tight and fast if it's crossing before momentum has really been lost, and it's too slow if it's not changing anywhere near the areas of consolidation where the market is taking a break from being in a trending pattern. The anchored VWAP and the 50 SMA both do a beautiful job of doing that most of the time for me on the ES or NQ futures on the 5-minute charts. Sometimes breaking a swing high or low beyond market support or resistance is enough to enter a trade because it's obviously with trend at a solid level and breaks with volume. There's always a risk of a retest, and many traders like to wait for that structure to be retested, especially if the break didn't happen with large impulsive candles. For that, we can wait for a retest confirmation. I was originally really frustrated with retests because I was taught them wrong. We aren't looking to buy the breakout point. We're looking to buy the swing high after the successful retest, or in a breakdown, the swing low after the retest of support. The retest adds to our probability of success because a retest is showing the market supporting that break. If the market can't come back through that structure again, that means it's because there are a large number of orders and prospective orders hanging around in this area. Now let's talk about the take profit and stop loss. We don't need to use an arbitrary number of points or anything like that because we're real traders trading a breakout using a systematic entry with systematic exits that are based on the actual market. You won't be able to afford every trade, and that's okay. Avoiding unnecessary risk in the market is a major part of our job. The market will have more opportunities, and you can always put the trade on in a paper account for practice if you really need to. The stop loss is super simple. It's the swing low of the break or before the break if price took some time to make the move. We have our targets from our analysis, our quant levels, our extensions, or our pivots. So now the risk is defined. How much risk you can take is really a whole other topic, but the elevator pitch is that the trade needs to honestly not threaten your account or threaten your mental cool if a bad trade happens several times in a row. Spending some time in your paper account practicing will help give you the best idea of how this feels, and also an idea of what the different ranges really offer in terms of their risk and profit on what you're looking to trade, because maybe you're not obsessed with the S&P 500 like I am, and that's okay. You won't always get a retest, and you know what that looks like. Assuming we've identified this level and we're ready to trade it, do you feel this chart? It's a gut punch, especially before you have the years of experience under your belt, where you've watched the market run away without you on a great trade idea you've had a few times before. First of all, don't forget that there are always opportunities in the market. Second of all, wipe your tears, change your diaper, and get ready to play those next opportunities. This is what working for yourself in trading is all about. The way we get chopped up in the market is trading between levels, so we can't just chase and hop on. Shout out to Rob for sharing it with us in this live webinar that I'll link. What is the fib width? I'll show you. So we're in a trend, and this is where you'll get on my case about time frame again, but I'm probably on the 5-minute, maybe the 3 or the 15, depending on the market and volatility, which naturally varies. We're in a trend because we've already taken our FOMO and benched it because it's not going to serve us here. So now what we're looking for is just a little micro break. Just one candle in the other direction. And it may end up being a couple, but it really just takes that one to get our attention. Now we wait for the first bar that trades back with trend, and there's our entry. With a stop at the new little swing low and take profits at our targets above. We want to buy as low as possible and sell as high as possible, but there's some balance with protecting our trading funds. It's a balance that some of us are better at than others, but fortunately, it's a skill that can be learned and developed. The more you stick to a system that manages your alert signals, entries, and exits, the easier it becomes. And then you can look at all the silly nuances that keep us busy, like volume profile levels, single prints, gamma squeezes, and whatever else. Before I go, I have some more just kind of general tips for trading breakouts. Trendline angles show strength, so when this angle starts to change, that can help you see a breakout forming. Volume's also really important to pay attention to. A breakout with high volume is bullish, but if a breakout has low volume, then that's kind of a red flag that it might be a retest. So similarly, if you're looking for a retest, but it has high volume, you need to kind of watch out for that being a breakout. And of course, stick to a system and trust the process. Whether it's this system or another one that speaks to you better, you really have to let every single trade play out so that you can get your statistical edge. Check out my links if you want to join our free Trading Ranch chat room, and check out my library of videos where I'm doing my very best to take all of the bullshit out of trading for you so you can get really great at it with me. That's all for now on breakout trading. Love you. Bye.